बैठना पड़ेगा आपको। और should I start?
Yes, sir.
So, are there going to be participants who will be joining on this particular thing, or it is already how the model is?
हम्म, सर वो यूट्यूब पे है सर वो।
Okay. So, I should start the presentation with all the communications.
हाँ, यस सर।
Okay. So, hello friends. A very beautiful and a very warm good afternoon to you all. And today's presentation, of course, is on budget. I'm not going to share any screen because it's a fun to give a presentation without there being a screen and seeing the screen and giving the presentation. It's altogether a different atmosphere where you give your presentation with all the informations available with you. So, with that, I'll be starting this presentation. The topic which has been allotted to me is all the pointers which are relevant from an NRI perspective and what are the important highlights which are available from NRI perspective. So, that's what is I'm going to cover up in this particular presentation. To start with, the first topic which I'll be touch basing to you is basically buyback, right? So we are all aware of there has been a lot of to and fro from the buyback provisions perspective right from 2013 onwards. So 2013, earlier it was capital gain tax, then it shifted to dividend tax, and then now again there is a proposal for moving back to buyback by moving back to capital gain taxation. So why this particular flow has happened? So what happened is that in the era from 2013 onwards, buyback was considered to be a dividend tax. So what used to happen is it was considered as income from other sources, and instead of there being 42% tax, actually what used to happen is the promoters and the companies used to use this as a mechanism wherein they used to go for a buyback and then tax it on a buyback basis. So dividend otherwise is taxed at 42%, and therefore instead of withdrawing the money by way of dividend, they used to do it buyback and used to pay capital gain tax. As a result of that, they used to pay lower tax and they used to get free from by paying a lower tax. Now government realized this fact, and now what they brought it is a change proposed in this particular concept of buyback, where they say number one, it is going to be a capital gain tax, so it is now no more going to be a dividend, and therefore capital gain tax will be taxed as normally which it used to happen, where you have a value and you have a cost and the net amount is getting taxed. So your net amount is going to be taxed in three different brackets, so for three different classifications. So let's say if suppose I am into a classification where I am a retail investor and I have got the money against a buyback, then I will be getting taxed normally as a capital gain tax, which is 12.5% or 20% as a short term or long term capital gain, as the case may be. But if I'm a there also there can be a two possibility. One possibility is that I'm a promoter of a company where being an individual and an HUF. So if I am an individual or an HUF as a promoter of the company, largely individuals, and if I am getting into a buyback of shares, then the tax rate will be equivalent to 30% and it won't be 12.5% because as a promoter of the company, I just want to execute the buyback by paying capital gain tax. But in order to have an equilibrium against dividend tax of 42% or 30% and capital gain tax at 12.5%, government has introduced this provision by saying that if a promoter of a company, being an individual, if he is executing this buyback, then in that particular case the tax rate would be 30% and it won't be 12.5%. Similarly, if let's say there's another situation where the taxpayer is a corporate, so for example, a company who has actually having a subsidiary, and the subsidiary shares are getting bought back. So in that particular case, company is going to get money. The holding company is going to get money from the subsidiary company, and in that particular situation, there is going to be a tax which is going to be 22%, which is equivalent to your corporate taxation. So broadly what they have tried to do is that dividend which is otherwise taxed at 30% or higher tax bracket, capital gain tax which is taxed at 12.5% or 20%, they have brought it an equilibrium wherein they are saying if you are a corporate and receiving a buyback, then in that particular case it's 22%. If you are an individual receiving money on buyback, then it is going to be 30%. But at the end of the day, there's going to be characterized as capital gain, so it's not going to be considered as dividend anymore. Now, therefore, the question arises is that all the provisions which were otherwise applicable, like capital gain exemptions, set off of capital assets, capital short-term, long-term capital losses, set off of those, whether DTA provisions accordingly will apply or not apply. So that questions, of course, will be arising, and therefore the point to it is that because it is a capital gain, it is characterized as capital gain. So all the provisions which were otherwise applicable for capital gain chapter is going to be made again applicable automatically over here. The only caution which ones need to be taken care of is the provisions of GAR, because GAR provisions are also the one which are there as a part of the statute. So therefore, if any arrangement which is impermissible arrangement, that is the only questions which may get into a GAR provision. So any impermissible arrangement which is only to take the tax benefit, then that will go it into the GAR provisions. Otherwise, it is going to be all the provisions which are otherwise going to be applicable for capital gain is going to get applicable over here again. So that's about buyback. Now I will go back to the second part. The second part is basically uh, for the NRIs and for the HNI investors. Basically, what used to happen is whatever is the investment used to happen on that. If you receive dividend, okay, or if there is a income from mutual fund, if you receive the amount as income, then 20% of that particular income was allowed as deduction pertaining to interest, so considering it to be against interest. So if you are incurring a cost of interest cost, then to the extent of 20% of the income is getting allowed. Now here in this particular provision, what they have said is that this 20% deduction no more will be available, and flat whatever is the income is that going to get taxed. Now what is the rationale which is applied beyond, on this particular proposal? The proposal is trying to put up that all the investors who are investing the money, they are the passive investors, so they are not the business. The objective is not business, the objective is to have a passive investment where the surplus funds are getting invested. So therefore they are of the opinion that any interest component, if it is being paid, then it results into a capital gain character. Sorry, it results in, I'm sorry, it results into a business character. So it's a kind of a business income and not capital, not a interest, sorry, not a investment income. So therefore their rationale applied is that all this kind of an income is going to be a passive income, and therefore flat deduction will not be available. And in case if it is related to business income, then of course you have that income getting taxed, and there is a corresponding expense available in business part. So here the proposal is that the 20% deduction which is otherwise available, a capping of 20% which was available, that is now removed and it won't be available. The third important provision which is there is uh, okay. Now, as we are all seeing, there is a lot of foreign investments getting attracted in India. There is a lot of technologies which are brought in back to India. There are a lot of technical expertise which are attracted in India. So here are the three provisions which are mainly from that perspective as to what are the important initiatives which have been taken in relation to foreign business, foreign expertise to be brought to India. So first one is that the government is going to come out with certain notified businesses, okay, which in my opinion can be like semiconductor businesses or AI related activities and so on and so forth, energy related activities, right? So they are going to come out with the notified businesses, and in those business on those notified businesses, whatever is going to be the technical expertise which are going to be received, so foreign technical expertise where the foreign technicians, foreign professionals are going to come to India, they are going to render that particular services, and the income is going to get generated for their foreign assets. So what, let's say Mr. A, who has been a non-resident, who is coming to India for rendering these technical services, and he is going to stay in India for a certain period of time. Now, in case if he stays in India, it makes him resident of India. In that particular case, his foreign income, which he is generating outside India, the government has proposed that that is not going to be taxed. So any person who is a non-resident who is coming back to India, and if he is entered engaging into rendering of a services for those notified businesses, then if he becomes a resident of India also, his foreign income will not be taxed in India. It will still continue to be exempt and non-taxable in India. Now, this is a very important initiative to attract a lot of foreign expertise and professionals to coming to India. Now, what are the two important conditions to it? Number one is that the person who is coming to India, he should be a non-resident for the first 5 years. So previously, he should be non-resident for 5 years. So somebody who was resident in India, who has gone outside India, and if he is coming back to India, let's say before 5 years, let's say 3 years, then he will not be qualified to this particular scheme. Okay, but somebody who is a non-resident, who is a non-resident for last 5 years, and then from the year when he is rendering the services for next 5 years, he will be able to take this particular benefit. And this benefit is that the foreign income will not be taxed in India. Okay, so that's an important initiative. The second initiative which the government took is that for the electronic goods manufacturing. Okay, so what happens is there are contract manufacturers who are in India. Now they are actually requiring lot of equipments, foreign toolings. Okay, the tools, equipments which are manufactured or which are available with foreign companies, they want to utilize that particular uh, tools or equipments. Now for that particular thing, all the foreign companies or the foreign corporates or entities who are going to render or who are going to provide this particular equipment to India, to the contract manufacturers, and that particular contract manufacturer is going to do a manufacturing activity for electronic products. Okay, in that particular case, the exemption is available till 2030. Okay, so this particular income will not be getting taxed in India. But mind you, the important point is it talks about providing capital goods. Okay, it does not talk about sale. So why I'm bringing this point is because if it is a sale of equipment, then generally all the sales happens outside India. Okay, the transfer of the product happens outside India, and it doesn't happen in India, and therefore that particular transactions are never been taxed. So therefore, any what signifies over here when the word provide is used, it can be a leasing contract, it can be a renting contract, and so forth, where the equipment is enjoyed for a certain period of time and then it is not a transfer of asset. So in that particular case, those particular income which a foreign company or a foreign entity is going to earn, that is not going to be that is going to be exempt for that specific sector. Similarly, there is a third one which is basically talking about the businesses which are related to data centers. So as the focus has been on a data center building activity, so all the data centers which are getting built up in India, which are under the scheme notified by government. Okay, and those data centers are owned and operated by the Indian entities. Okay, a foreign company, when they are providing any services through that data centers, and that data center is in turn providing those services through an Indian entity. Okay, so there's a data center is providing the services through an Indian entity, and that data center is receiving certain services or procuring certain services from a foreign entity, and the income is generated from that particular income will be continued to be exempt for a long duration till 2047. So that's one more amendment which is got introduced. Moving forward, gold bonds. So all the NRI investors or all the investors who used to HNI and NRI investors who used to invest into gold bonds. So the law is that previously the law was that all the redemption of the foreign of the souvenir gold bonds, okay, was exempt. Okay, now the change which they have brought out is that it should be an original subscriber. So the redemption which is there should be by the original subscriber who have taken the bonds from RBI. Okay, so the bonds, if I have taken from RBI, and now if I'm redeeming those particular bonds, I remain to be an original subscriber and I will still continue to get that exemption available. But for the person who is subscribing from local market, so that used to happen. So if the people are purchasing from local market, and if then they are redeeming, then this benefit of exemption will not be available, right? So now moving to the next point, and the important one is the foreign asset disclosure scheme. Now, this is one important thing which has got introduced, and we need to get into this particular point. Uh, so, what happened is in past maybe 2 or 3 years, there have been lot of notices which are issued for the assets not getting disclosed, and there are a lot of small taxpayers who have got this particular notice because they have not disclosed their foreign assets. Now, this has resulted into a lot of compliance issue because the penalty which they have levied or proposed on that particular notices is approximately, not approximately, it's basically 10 lakh of rupees. That's something which is relatively huge. So, what is proposed and what has been brought out in this particular amendment is three or four things which I'll be briefing it to you. Number one, which they are saying is that if there are any foreign assets, okay, which are not reported in ITR, okay, but these foreign assets are bought either through a foreign source income when you were a non-resident, okay, or it is purchased, it is bought or acquired through a Indian source income which is already offered for tax. So if you, let's say, have bought a foreign asset, now that foreign asset is uh, bought through a foreign source income when you were a non-resident. So that means that particular source of income was never taxable in India because you were a non-resident at that point of time and you have acquired an asset. Okay. The second situation can be that you have acquired an asset by an source of income in India, which is already offered for tax. So now the government does not have any tax to be collected out of that. It is only a disclosure deficiency, which the taxpayer has not reported that particular asset even after becoming a resident of India. So in that particular case, the fee which is being declared, which is proposed, is 1 lakh rupees. Okay. Uh, if we make this voluntary disclosures, so if we go forward and make a voluntary disclosure, then in that particular case the fee is going to be a lakh of rupees instead of the 10 lakh notice which is getting received. Number one. Number two, the important eligibility for this particular opting of the scheme is that the asset value should be less than 5 crore of rupees. So if the asset value is more than 5 crore, the aggregate asset value is more than 5 crore, then this scheme is not applicable. Okay. So that is the second thing which we need to look into. The Now we move to the second category. The second category is where you have a foreign asset, okay, that asset is purchased or acquired through a source of income which we are not able to explain. So that's an unexplained source, number one. Number two, it can be that the source is proved, but the tax amount which was actually supposed to be offered has not been offered. So it's an undisclosed income. Okay. Undisclosed income which is chargeable to tax. Okay. So if it is an undisclosed income chargeable to tax, and if that particular source, through that particular source, if we have acquired an asset, okay, then that is again a second category. So if there is an undisclosed income, if there is an asset which is not reported, okay, but that is through a source of income which is not explained, then in that particular case we will fall into category 1. Now what this category is trying to say, so this category is trying to say that if you are into this category, if your undisclosed income or value of the asset is less than 1 crore rupees, okay, then you are eligible for this particular voluntary scheme. You can come forward, make a declaration and pay taxes. Okay. Now what are the taxes? The taxes are that if your undisclosed income is there, then you have to pay 30% tax, and on that 30% is fee. So 30% tax, 30% fee. So basically, sorry, 30% tax and 100% fee on that 30%, which is amounting to 60%, right? So that's number one. Number two, if you are having an undisclosed income, and if that is also less than 1 crore of rupees, you can voluntarily come forward and make a declaration. In that particular case, also, you are liable to pay 30% tax, and you are liable to pay 100% fee on that, which is again 30%. So 60% is what you are supposed to pay. Now there are questions which are coming across in this particular lines, which I would like to address it over so that there is more clarity to this particular scheme. Now the first question which is there is what is going to be the uh, value of the asset. Okay, so let's say if I have acquired an asset, let's say in 2018, and that asset was acquired through an undisclosed source. Okay, now the asset, let's say when I acquired, the asset value was, let's say, 60 lakh of rupees. Conversion done, after conversion it is 60 lakh of rupees. But today the value of asset is more than 1 crore rupees. In that particular case, what is going to happen? Situation number 1. Situation number 2, let's say the asset is something which is disclosed, and the rate at which I have acquired, at the dollar conversion rate was 72 rupees. Okay, now the dollar conversion rate is 92 rupees. Okay, so in that particular case, what rate is to be applied? Now the scheme, maybe by way of notifications, they will make these clarifications, they will bring out the clarifications on it. But today the clarification is something which we are still awaiting for. But logically, if we apply, okay, what is the objective of this particular scheme? The objective of the scheme is to identify, or to encourage the taxpayer to come forward and give their declarations. Okay, that is the core objective. And the second objective is, it is trying to restrict themselves to the smaller taxpayers and not the large taxpayers. So the if we look from the motive perspective, the motive is that all the small taxpayers who have not disclosed their income, or who have not disclosed their asset, now if they are coming forward and they are making this declaration, then the scheme is trying to encourage them. As a result of that, what is the answer for valuation? In my opinion, logically speaking, it should be the value on the date in which I have acquired the asset. Because today if I go and tax it, I need to tax that particular value at the date on which it was acquired, because that is the undisclosed income. Okay, and that is the undisclosed value of that particular asset. So that needs to be taxed, and not today's value, which is a notional value, which may not have got liquidated. Okay, so therefore that's the logical answer. Of course we need to wait for some clarifications, etc. But at the same time, I would also like to bring up one more point. In such kind of an ambiguity, when this kind of a VRS schemes are getting launched, in that cases, even if these ambiguities are there, we should make a declaration and await for the answers from the authorities. Because generally speaking, it has so happened that when you make a declaration and it is having a logical binding behind that, then the cases have been taken into consideration and the schemes have been considered. So the declarations have been considered. So therefore we have to wait for the answer to a clarification to this particular thing. But logically speaking, it should be the date or the value at which the asset was acquired, right? Number one. We go to number 2 point. The number 2 point is what happens for the past years. Because my asset I have not disclosed, let's say from 2018. In this example, I have not been disclosing this asset since that particular year, and today this declaration scheme is there. In my opinion, again, no straight clarification, but logically speaking, in my opinion, the answer is that all those past defaults, okay, are should get immune. Because you are going for a self declaration and you are making this particular disclosure. So therefore that particular past default should get immune, in my opinion. But yeah, let's wait for some clarifications on this. But logically speaking, it should be like this. The third question can be, let's say I and my wife, we were non-resident. We had bought this particular asset together in joint, right? Now we both are resident. And now we are going for declaration. So whether we need to make two declarations, answer is yes, because you are a joint owner of the asset, and therefore a proportion of asset belongs to your account and proportion of asset belongs to wife account. Therefore you need to make two declarations for that, right? So now these are broadly some of the questions which can come across while we are getting into this particular scheme. I'm pretty sure there can be a lot of such more questions which will come across, and we'll be very happy to answer those questions on email one to one, where somebody wants to discuss about those particular questions. Then we can always you can always reach out to me on my email ID, which is darshak@snco.in, and I will be happy to answer your questions related to this particular scheme. Moving forward, what are the other important changes which is there, which I would like to bring it up to your notice? The next point is related to transfer pricing. Now, in transfer pricing, what used to happen is, uh, let's say I have gone for dispute resolution. So I am a non-resident. I am not satisfied with the draft order which is passed by the assessing officer, and therefore I am going to the DRP for my resolution, dispute resolution. Now, when I went to dispute resolution, my order was there, the draft order was available, but because dispute resolution has its own timelines, so my order, the final order, got passed beyond the due date of file closing the assessment. So there have been some instances before the courts where the courts have given an opinion, or the courts have given the ruling that the timelines under 153 needs to be followed. But there has been an argument against that also, saying that if 144C, which is having a independent timeline, so why should that not overrule section 153? And therefore the clarification is brought out in this particular budget, where they have very clearly stated that if the draft order is passed on time, which is within the limit under 153, then the procedure needs to be followed as per 144C. Timelines will be adhered as per 144C, and the order will get completed as per 144C, and that will overrule the timelines of 153. So that's one clarification which was required, and that has been brought out in this particular budget. The next point which is there is related to notices under reopening. So there have been cases where the jurisdiction officer have passed certain matters. Okay, so they have raised notices under 148 and 148A, and the question was that whether the jurisdiction assessing officer has the power to issue the notice, or it is only the faceless unit which can issue the notices, which has got clarified now, and they have said that the jurisdiction assessing officer, being also the assessing officer, therefore he is also having a power to issue the notice. So therefore this takes care of 148 pointers. Some of the other questions I would like to, because I have got these questions from different people, and therefore I have made some small compilation of this particular questions related to the foreign disclosure scheme. So I will just read out the question and I will answer those questions to you. So the question is, if the foreign asset has reduced in value or become worthless, will tax still apply? So, in my opinion, the answer is yes, because if the foreign asset, let's say, was of a crore of rupees, okay, and now the value has got reduced, or if the foreign asset was of, let's say, 3 crore rupees, and now the value of assets have got reduced. Now, if we are going forward, we as a taxpayer are going forward and making a declaration, the objective of the scheme is to encourage, again I'm repeating, that encourage the taxpayer to declare. Now if that 3 crore of asset have got reduced to below 1 crore, and we are going for this particular scheme, whether we should be going for it, the answer is yes, because the tax which is going to be there is going to be on the original value. But if you want to go and make a declaration, the option is available. We can go for this particular declaration. Next question, if foreign income was already taxed abroad, okay, can I claim foreign tax credit? So let's say if a particular income based on which I have purchased an asset, okay, and that asset I have not disclosed. Now that happened to be an undisclosed income, and therefore the question is that whether the foreign income, when I'm offering this under this particular scheme, whether I will be able to claim foreign tax credit. Now, this is a matter which, of course, need requires certain level of uh, clarification. More than clarification, it requires a detailed call to be taken on it, because under this particular scheme, if I go and say that I'm offering this amount for taxation, and because the amount is getting offered because there is an undisclosed income, and on that undisclosed income I'm offering the tax, then in that particular case, whether the foreign tax credit will be available or not, that's a matter of uh, detailed study in terms of it. And therefore we need to get more into the details to identify whether that credit will be available or not available. That's number two. Number three is, if I disclose the foreign assets in scheduled FA but not the income earned from it, what happens? So I have made my disclosure of foreign asset, but I have not offered the income which I was supposed to offer. Then in that particular case, again, the scheme will levy a tax because the undisclosed income is not getting taxed over here. Now, when we say undisclosed income, we are talking about undisclosed income which is chargeable to tax. So that undisclosed income will have to be considered for the purpose of taxation under this particular scheme, in spite of the fact that the foreign asset is getting disclosed, right? So we may take as an example, previously there was a wealth tax. So under wealth tax, though my asset is getting disclosed, if the source through which that asset was acquired, if that source is not offered for tax, then that does not mean that if I have reported that foreign asset, sorry, if I have reported that asset in my wealth tax return, that does not give me a advantage of not paying tax on my undisclosed income in this example. So similarly, if I'm going and I have reported my foreign asset, but if I have not offered my undisclosed income, and if I am liable to pay tax on that particular undisclosed income, I can go and opt for this particular scheme, and the tax will be only limited to 30% on undisclosed income plus fee of 100%. So that's how it is going to get calculated. If I disclose the income but not the foreign bank account, will asset tax apply? Answer is yes, because it talks about both. Now, the only thing is that if you have already disclosed the income, if you have already paid the tax on it, then you will fall into category B. Okay, because your income is already taxed. Now the asset is not reported. So if the asset is not reported, you are not getting into category A, you are getting into category B, which is 1 lakh of fee. So that's how we'll have to look into it. Can I revise or withdraw my declaration if valuation goes wrong? Answer is yes, you should be able to do it. We need to understand and get the clarification, but please also appreciate the fact that the moment you go for a declaration, you are disclosing that particular information to the tax authorities. And of course, when you go and back to withdraw it, you are reducing your immunity power. So your immunity powers, etc., are going out, but your disclosures are already available with the tax authorities. So that's going to be a very complicated game, because your disclosure made, but now you have lost the immunity because you have withdrawn the declaration. So I would not suggest somebody to do it. In fact, somebody should be very clear with clarity when he is going for this declaration, and should not be getting into that particular hustle of withdrawal of that particular appeal at a later point of time. So that's number three. If I fail to pay within 2 months, does interest apply like regular tax? So here what they have said is that you have to make a payment within 2 months. Okay. And then of course they have said that if you are not making the payment within 2 months, then of course the provisions related to interest and penalty will apply. So that is going to be a separate thing, but basically the point is that they are asking us to make an application. After making an application, if the application is getting accepted, then within 2 months we'll have to make the payment. Now the next question is: can the department give me an immunity from the prosecution, penalty, etc.? The answer is yes, because this declaration is specifically for this objective. The declaration is mainly from a perspective that uh, if you go for this particular declaration, your immunity power is actually triggered, and you will be immune from all those prosecution penalties, etc. So that's broadly, I believe, answers the questions which was running across, and there were questions which have been raised to me, and broadly I hope I'm answering those questions to you. Some other important things which I would just like to bring it up is, and that's important from an NRI perspective, because this kind of things are just moving around. A lot of notices are getting issued in relation to it, and therefore all these points are though applicable for resident, but they are equally applicable for NRIs also. The next point is that unexplained income. So earlier, the unexplained income was taxed at 60%. Okay. And then there was a surcharge of 25% on it, which was topping up to somewhere around 84% or something like that. Now, what they have done is they have said that, what they have proposed is that the tax will be at 30%. So instead of 60%, the tax will be at 30%. But now there are going to be a penalty provisions of misreporting, etc., which will be applicable. So it may so happen that your tax have got reduced from 60% to 30%, but eventually you end up of paying more outflow at the end of the day, because your penalty component have got increased. So earlier, which was used to be somewhere around 84%, can now go from somewhere between 98% to 128%. So that's the range in which it can go to, and therefore one needs to keep this point in mind. So the point is that it is not reduced only to 30%. In fact, it has the tax rate has got reduced, but the overall tax outflow, including penalty, has got increased. Right? Uh, I think broadly I'm covering major part of it. Just 1 second. Yes. Now, in block assessment, this is one of the point which I would like to address. So, what used to happen is in block assessment, let's say there is a search happened at my premises, okay, and at my premises when the search has happened, there are certain information which are reflected for Mr. A, whose whose uh, uh, income or whose assets are found to be undisclosed, or it's a subject to further detailed search on that particular person, Mr. A also. Now my block is going to be for a longer period of time. Okay. So after completing of my search, when the matter is going to go for assessment, it is going to be going for a block assessment. Now here my block assessment is open for a longer period, but the change or the proposal is that earlier even Mr. A's assessment used to get open for a longer period equivalent to what mine is. Okay, but now the proposal is that Mr. A, if the income pertains to the financial year prior to this particular search, then that period will be taken into consideration. Or if it pertains to any particular year, okay, then that particular year will be open for assessment. So it's not going to be a block for him. It is going to be that particular specific year for which the assessment is going to happen. There's one more uh, proposal which is basically for lower deduction. What is this proposal trying to highlight? So currently, what used to happen is whenever we used to go for a lower deduction certificate, we had to submit all the list of informations about justifying why my tax outflow for the current financial year is going to be lower, because the objective of for going for a lower deduction certificate is that my tax outflow is going to be lower, and therefore I'm appealing to the tax office that my because my tax outflow is going to be lower, you grant me lower deduction certificate, which I'll be handing over to my deductors who are going to pay me the amount, and they will be also deducting at a lower amount, and therefore my cash outflow is getting preserved, right? With that objective, this lower deduction certificate works. Now there are a lot of instances where lot of informations are submitted every year. So there this particular taxpayers goes for lower deduction application every year, and therefore all this list of information is already provided year on year to the tax office. But as a part of the procedure, they have to collect all this information, we have to submit all the information every year, and therefore there is a lot of duplication of information. And to avoid that, instead of manual verification, they are proposing for electronic verification. And this is what I believe it will be, that because the database is already available, okay, there can be a lot of information related to a taxpayer which is going to get validated internally through a data system electronically. And if there are still certain questions, they would be throwing those questions, but otherwise electronic verification will happen and the lower deduction certificate will be granted. Now this is going to be available only for a limited prescribed taxpayers. It is not going to be open for all. It is going to be for that limited people, and that's going to be listed. So that's the provision. The provision is saying for that class of people who are going to be prescribed, which are considered to be a small taxpayers or lower taxpayers, then they will be able to go for this particular application. Instead of giving all the manual data, you can give the data which are already available. The tax office system will be able to electronically map the data and come out with the conclusion. That's the proposal. So broadly, I think I have covered all the points which are related to, which I believed is related to NRIs, HNIs, foreign companies, etc. I'll be very happy to open the floor for any questions if they are. And if there are no questions, I would thank you everybody for listening to this particular presentation. And any questions related to the budget, related to NRI taxation, you can always touch base to me on my emails, which is at darshak@snco.in. Yeah, we'll be happy to answer those questions. And thank you, Tax Guru, as a platform for giving this opportunity.
थैंक यू वेरी मच सर। सीए दर्शक शाह सर, कुछ क्वेश्चन एक ही स्टूडेंट ने पूछे हैं।
Hmm.
ये मैंने अभी चैट पे डाले हैं सर, यहाँ पे।
ओके, मैं एक सेकेंड
यही
ओपन करता हूँ।
इसी चैट पे डाले हैं।
ओके, सो उन्होंने लिखा हुआ है कि इन केस ऑफ अ जॉइंट अकाउंट इन फॉरेन बैंक, account disclosure between husband and wife, can 50% be disclosed in each of the returns? Is so answer is yes. Is now that 50% is of course because your bank account will also be having that particular co ownership as a holding, and therefore 50% disclosure will make sense. The second question is the retirement pension fund which cannot be withdrawn until age 60. Does this comes under the category B? The source of funds have already been taxed outside India few years back. So to answer this question, I need to have some more information. So what my answer will be that to fall into category B, what is important is that the asset which is acquired is through a foreign source income which is not taxable in India, or it is from the Indian source income which is taxable and the tax is already offered for it. The whole sum and substance of the category B disclosure is that if you have failed to make a disclosure, you make a disclosure and be out of it by paying 1 lakh rupees fee. Government is not going to be is not being able to tax that particular transaction because it is virtually the source income is not taxable. So therefore you need to see whether you are falling into category B based on this particular parameter, that the income source, whether that is taxable or not taxable, and if it is taxable, whether the tax has been offered or not, right? Next is, do I need to revise ITR for March 25 to include the fixed assets disclosures? Only asset disclosures was inadvertently missed, no foreign income. So yes, that is option available, and therefore you can do it, and you can take that particular advantage. Uh, what? Just one second. Just one second. So when you're talking about a revision of particular income, so this is going to be applicable from assessment year 26, so this is possible, right? Yeah, so that benefit can be taken. What is that 20 lakh limit apply? Does penalty still apply for foreign income less than 20 lakh? uh, I'm missing on the point of this 20 lakh. What is this 20 lakh worked out to? What is this 20 lakh work out to? I just need to see that. So I'm missing on the point of this 20 lakh, what this refers to. So if somebody can put it on the chat, I'll be able to answer that. Because I don't refer to this 20 lakh limit. So where is this amount coming from?
अभी उस कोई रिप्लाई नहीं आया सर उनका, मैंने अभी भेजा था, कोई रिप्लाई आया नहीं है। बाकी बहुत अच्छा सेशन रहा सर आपका ये वाला।
जस्ट एक सेकेंड रुकेगा सर।
ठीक है, ठीक है सर।
Okay, I think we can leave this particular communication over here. Thank you very much for giving me this opportunity and presenting my thoughts onto the budget. Thank you very much. Shall we leave the presentation?
यस सर, थैंक यू वेरी मच सर। मैंने अभी
Okay, bye bye.
हाँ,
Take care.
थैंक यू सर।